was really, really ugly, really badly ugly in the stock market and the bond market. And most of us don't own stocks or bonds directly, but we own them through funds. And most of us don't have investment accounts, but we do have retirement accounts. We might have a Roth IRA, a traditional IRA, a SEP, a 403B, could have various versions. I mentioned 401ks, I forgot. Anyway, we have, did I say Roth IRA, traditional? I said all that. So this month, you got your statements for last year. They may have come just in the last couple of days. And it's not good. If you're invested in a typical portfolio, you probably lost somewhere a little under 20% of your account value last year. But what's really weird is that if you have a mixed bag of bonds and stocks, like I'm very classic 60-40, 60% stock index funds, 40% bond funds. So bonds normally protect you when stocks go down. Not last year. Bonds went down typically around 14% last year. Very, very rare. How rare? I saw something in Barron's that the cycle is mathematically typical once every 130 years. Now, I don't know if that number is on the nose, but it does point out how rare what happened in 22 is. I mean, extremely rare that you're going to have stocks of all shapes and sizes do this big decline, and bonds are going to do the big decline, because usually the bonds protect you at a time that stocks are falling. But we had such an unusual set of circumstances that I can tell you it hadn't happened in my lifetime, and maybe it is once every 130 years. So know this, the value of your accounts should have declined all the way back to where they were at the end of 21. That's right. The declines we suffered last year should have taken you back just a single year in the value of your accounts, because we had these big run-ups in value in prior years. And we've had an incredibly up market from 2009 till the end of 21. We had a big upward movement in stocks, and 22 was a terrible timeout. So we always feel losses much more powerfully and painfully than we enjoy the gains when those are happening. And if you have old records, look back and see if for you what is generally the case is also true, that what you had at the end of 21 is what you're looking at. The end of 20. What you had at the end of 20 is the same as what you had at the end of 22. Somebody was going to point out, Clark, your math is all wrong. No, that math is right on the money. And so we did lose some time here, but it is typical and normal that investments go through cycles that are wonderful up cycles followed by really ugly down cycles. And you have to be willing as an investor, when you use the word investing means you're putting your money at risk. You have to be willing to take the scary ride on the roller coaster down in order to get the long-term benefit of the roller coaster going up. So this is a long way around of saying, I have made not a single meaningful change in my portfolio after I've seen the ugly losses of 22, because I know that the strategy and the investment direction I'm in long term pays off. The people who really suffered from the decline in the stock market in 22 are people who have just retired. And they had money they were anticipating being able to live on that evaporated overnight. And there's no minimizing that. But their money will recover as well. But it means a couple of uncomfortable years. As for this year, anybody who tells you what the market is going to be like on the last day of 23 versus the first trading day of 23, anybody who says, oh, this is what's going to happen, they're just talking, because you can only look back and say why what happened, but you cannot accurately predict in the short term what values will be in a short cycle. But you can predict with virtual certainty that enough years in front of you, the market will be your friend and grow your money faster and better than anything else with those scary down cycles of the roller coaster.